Commodities soaring since Russia's invasion of Ukraine, with prices on pace for their biggest weekly gain since the 1960s. And check out this chart. It shows WTI crude oil prices versus two-year break-even inflation rates. BK calls it the most important chart in the market right now. Why is that, Beeks?
Yes. Well, so listen, the two macro drivers out there, they're pretty obvious, right? What is the Fed going to do, and what is happening in Ukraine? So the epicenter, the market for what's happening in Russia, Ukraine, is the oil market. We know a lot of those Russian barrels are off the market, so oil prices are spiking. But look at, and then on the Fed side, Chair Powell said today in his testimony, he does not want inflation expectations to get embedded in the U.S. economy. That's what these two-year break-evens show. They show what are inflation expectations. People are expecting, or at least the market is expecting, inflation over the next couple of years, 2 years, is going to run at 4%. And lo and behold, a lot of that inflation expectation is driven by oil prices. So this encapsulates everything that's going on in the market right now. So for the bulls, what you want to see is oil moderating, inflation expectations moderating, and the Fed maybe taking their foot off the brake a little bit. That's why I think this is the most important chart. If you see oil spike and inflation expectations spike, I bet you the Fed's going to come in and they're going to raise 50 basis points, maybe not in March, but the next meeting, if you get these two things continuing to move higher.
What do you think of the chart, Tim?
I like it. I think we've also truncated or condensed and made a higher octane velocity commodity cycle here. Take out your 2004 through 2007 playbook. It's game on. Steel prices are going a lot higher. If you look at U.S. Steel as a company, also they've been buying back a lot of stock. The free cash flow generation for a company that had a bad balance sheet, pardon the simplified term, that's really what was going on. And they're locking in at cold rolled steel price contracts year over year, up 10, 15, 20%. There's nothing anybody can do on the customer side. We're seeing this across iron ore. We're seeing this across the ag space and fertilizers. Look at Mosaic. Look at potash. So I think this is a story where this is part of that inflation dynamic. And even in the short term, where I think the dollar continues to trade higher, again, part of the key here is that a lot of these companies, not the commodities, are better run than they were in the early 2010 through 15 area, where there was growth at all costs. And frankly, there wasn't the demand side and the supply side support.
Alcoa was your final trade yesterday. But it goes, I mean, as Tim mentioned, it's way beyond. It's the whole entire commodity complex, including the related equities, like the fertilizers, the FERTs.
The FERTs. That's like fast money. 2010-ish.
I know.
I mean, that's
classic.
Early Melissa Lee fast money.
Very.
And you're spot on to bring it up. I mean, Jeff Curry, not me, he runs commodities at Goldman Sachs. So this is somebody that knows what he is talking about. He said a couple weeks ago, if not a month ago, I've never seen anything like it in my 30 years in the business. We're running out of everything. I'm paraphrasing a little bit, not that much. And all these names works. Quickly, Cliffs has been a name we've talked about, CLF. I just bring it up because we are right at levels we topped out at in August of last year, critical levels. I happen to think they're all blowing through the upside. I can understand if you'd want to take profits here.
So, BK, how do you trade your most important chart in the market?
Yeah, well, I mean, I think you can trade, first of all, just be long oil, number one. I think that's the easiest way to do it. You can be long oil services. OIH is another way that I'm playing it. But we're talking about commodities more broadly. Freeport Mac looks fantastic to me. Copper just started to break out right now. Gold looks like it's going higher. If inflation is going to be higher than bond yields, then you have negative real rates. Very positive for metals. So I think Freeport Mac probably captures all of it.
So, I mean, we're bullish on this whole complex, BK, but I mean, the long game would be that you're negative on the U.S. economy. You're potentially negative on the consumer, too. If you're making this bet, do you have to believe that inflation does get out of hand?
I don't think you have to you don't have to believe it gets out of hand. I happen to think it is going to, but you can still make this bet without thinking it's getting out of hand. But ultimately, right, if inflation gets too hot, you're paying $7 for a gallon of gasoline this summer, that is going to be a drag on the economy and the consumer.